It is April 15th, aka Tax Day. Welcome to the Market Update Desk with Scott Riley, NMLS number 157524. Want to go over a little bit of what was going on yesterday and today. We also had earnings season start on Friday. Lo and behold, of course, Goldman Sachs knocked it out of the park on Monday. Their stock rose a little over 10%. This morning, Bank of America showed better earnings than expected. It's amazing how Goldman, BlackRock, Bank of America, etc., seem to always do well. Very interesting. So, there's been a lot of chatter about the US dollar and concerns about it being the world's reserve currency, especially after comments that we had a couple of days ago from former Fed chair, I'm sorry, former Treasury Secretary and Fed Chair Janet Yellen. Now, keep in mind, Janet Yellen is the one who mysteriously issued significantly more short term bonds than long term bonds when yields were extremely low, costing us tens of billions of dollars in interest carry. So I take what she says with a grain of salt. She indicated the dynamic rise in treasury yields simultaneously with the decline in the dollar suggests that investors are beginning to shun the dollar based assets. The dollar has moved sharply lower last week, and there were talks that it was the lowest level in years. While that is true, we have to look historically. This is not an unprecedented level. Now, if you look at the charts, it shows we've been at or even below these levels several times over the last few years. And the dollar was even below these levels in pre-pandemic times. Additionally, when we look at it, if the dollar was losing so much of its luster and there was less demand for the 10-year treasuries, then why in the world was last week's 10-year auction so strong? More importantly, indirect bidders, which represent foreign buyers, accounted for a touch over 88% of the auction. Now, this is compared to the norm last year, where it was a 67% of indirect buyers. It was the highest takedown by foreign investors on record. So it's concerning to see yields higher and the dollar weaker, but we don't feel it's a reason for panic yet because 50% of the global transactions are done solely in the dollar, while 89% of those total transactions are done with one side being marked to the dollar. So it's way too soon to say the US is at risk for losing the reserve currency, but it is something we do want to follow as we keep moving forward in time. Now, we also had Monday some comments by New York Fed President John Williams spoke about that he believes GDP will slow down to between 1 and 1.25%, and thinks unemployment rate will tick up to anywhere from 4.5% to 5%, and sees inflation somewhere between 3.5% and 4%. Now, on monetary policy, Williams feels that the current modestly restricted stance of the Fed is appropriate, given the labor market and current inflation above 2%. It'd be real interesting because if we see unemployment between 4.5% and 5%, that's more than likely going to outweigh the trader's opinion of where the bonds need to be if inflation is still 3.5% to 4%, because a lot of what drives the bond market is critical to employment numbers, and 4.5% to 5% is a substantial uptick from what we currently are seeing in the market. So tomorrow is going to be a very important news day, starting with retail sales. Now, that's going to give us a read on the health of the consumer and their spending habits. Industrial production will also be released. Now, that's one of the main pillars of the NBER, the National Bureau of Economic Research, when they use that for determining if we're in a recession. So it's going to be closely monitored, especially with all the talk about possible recessions that we've had in the chatter over the last week and a half. Also, tomorrow we're going to get a 20-year bond auction. Now, it's going to be important to see what the appetite is for that, because again, based on last week, the other day's 20-year auction, I'm sorry, the 10-year auction had incredible demand from foreign buyers. So we're going to watch that 20-year auction very closely. Now, lastly, Jay Powell will be speaking around 1:30 Eastern Time. It'll be very interesting to hear his thoughts and commentary on the volatility that we've been through over the last week and what his narrative is going to be on tariffs, dollars, and the treasury market. On the technical side, mortgage-backed securities are trading, trying to actually rebound for a second straight day. We're slightly in the positive today. Momentum is on our side, which is a good thing via one of the stochastic indicators. And there's been a 2-day candle pattern that pretends to higher prices ahead, which are good for mortgage-backed securities. So MBSs are testing overhead resistance at the 100-day moving average. And if we can break through that level, the next stop is the 200-day moving average, which is about 26 basis points above our present levels. Additionally, there was a golden cross. Now, that's where the 50-day crosses over the 200-day moving average a few days ago, and that can lead to better prices ahead. On the 10-year, actually, right now we're sitting on the 10-year at 4.38. So it's a little bit flat today. I think one tick better. It broke under its 100-day moving average. The next stop is actually a dual floor of resistance, and that's at the 50-day moving average, and that's a 4.33% Fibonacci level. Just like mortgage bonds, there's a favorable stochastic crossover that's forming, which could give us lower yields. The S&P formed a death cross the other day where the 50-day average crossed over the 200-day moving average. That often signals that stocks will continue to be challenged and possibly lower. So we're busy here at the Market Update Desk, analyzing numbers, getting information to our clients. Give us a call, and we're happy to be your resource. We're the original singular market news source for West Michigan. 616-293-2189. Have a great afternoon.